Did you know that some of the wealthiest people in the world made their fortunes by investing in just a few key industries? Today, we will delve into the top 5 investment strategies employed by some of the world's most renowned billionaires. Whether you're an experienced investor or just starting your financial journey, the insights and advice from these billionaires are sure to provide a valuable framework for building wealth. Let's dive in. 1. Warren Buffett's value investing and long-term holding. Perhaps one of the most well-known and respected investors of all time, Warren Buffett, the Oracle of Omaha, has a net worth of over $100 billion, much of which has been accumulated through his incredibly successful value investing strategy. Buffett's investment philosophy revolves around the principle of buying and holding undervalued companies with strong fundamentals and long-term growth potential. Buffett's mentor, Benjamin Graham, is often regarded as the father of value investing, and his influence on Buffett is evident. Value investing involves identifying companies that are trading below their intrinsic value, often due to market undervaluation or temporary setbacks. In one of his most famous deals, Buffett invested in a brand that was already a household name, and the profits he made from this investment further solidified his reputation as a savvy value investor. In the late 1980s, Buffett started acquiring shares of Coca-Cola, a company with a strong global presence and a well-loved product. By April 1988, Berkshire Hathaway had accumulated around 23.3 million shares of Coca-Cola stock, amounting to a substantial 6.2% ownership stake. The total purchase price for this massive investment was approximately $1.02 billion, a significant sum at the time. Buffett's intuition proved correct, and this investment turned out to be a windfall. By 2016, the value of Berkshire Hathaway's investment in Coca-Cola had skyrocketed. The initial $1.02 billion investment had grown to a staggering $16.5 billion, resulting in a massive profit of over $15 billion. This incredible return on investment showcases the power of Buffett's value investing approach. Buffett is known for his long holding periods, buying and holding forever as long as the company's fundamentals remain strong. This strategy reduces costs and taxes and allows investors to benefit from compounding returns. Berkshire Hathaway has delivered an average annual return of over 20% since 1965, significantly outperforming the S&P 500. By following Buffett's lead, investors can focus on quality companies, buy at attractive prices, and hold for the long term. 2. George Soros Contrarian Investing in Global Macro. George Soros, a legendary hedge fund manager and philanthropist, has a net worth of over $8 billion. Soros is known for his contrarian investing style and his success in global macro trading, which has earned him the moniker, the man who broke the Bank of England. Soros is famous for his willingness to go against the grain and take contrarian positions. He seeks to identify market trends and invest in ways that contradict the current market sentiment. One of the most notable examples of Soros' contrarian investing was his short position on the British pound in 1992. Soros believed that the pound was overvalued, and that the Bank of England's efforts to prop it up were unsustainable. In 1992, Soros shorted the pound sterling, believing that the British government would be forced to devalue their currency due to economic pressures. Soros and his quantum fund began accumulating large positions in derivatives that would profit from a decline in the pound's value. The exact amount invested is not publicly known, but it was likely a significant sum, given the magnitude of the trade. Soros' bet proved correct. On September 16, 1992, known as Black Wednesday, the British government was unable to defend their currency's value and was forced to withdraw it from the European Exchange Rate Mechanism, ERM. The pound plummeted, and Soros' fund reaped enormous profits. It is estimated that the quantum fund made around $1 billion from this single trade. Soros is also known for his expertise in global macro trading, which involves making investment decisions based on global economic trends and events. He analyzes political and economic factors to identify potential opportunities, or risks that may impact asset prices. In 1997, Soros turned his attention to the Asian markets, particularly Southeast Asia, where economies were experiencing rapid growth but also building up financial vulnerabilities. Soros identified signs of overheating and increasing debt, which he believed would lead to a significant correction. Soros and his quantum fund began shorting the currencies of several Southeast Asian countries, including the Thai baht, the Indonesian rupiah, and the Malaysian ringgit. They also took positions in other related financial instruments, such as stocks and bonds, to profit from the anticipated decline in these markets. The exact amount invested in this strategy is not publicly known but was likely substantial. Soros' bet proved correct, and a crisis unfolded. Starting with Thailand in July 1997, currencies across the region began to devalue rapidly, and stock markets plunged. The crisis spread to other Asian countries, and international investors pulled their capital out, further exacerbating the situation. The quantum fund profited handsomely from this global macro trade. As the currencies and markets of these countries plummeted, Soros short positions generated significant returns. While the exact figures are not disclosed, it is estimated that the fund made billions of dollars from this strategic play. 3. Elon Musk's disruptive innovation and diversification. Elon Musk, the enigmatic founder of SpaceX and co-founder of Tesla, PayPal, and Neuralink, among others, has a net worth of over $200 billion, making him one of the richest people in the world. Musk's investment strategy revolves around disruptive innovation and diversification across multiple industries. Musk is a firm believer in the power of disruptive innovation to create value and drive progress. He focuses on industries that are ripe for disruption, such as transportation, energy, and space exploration. By investing in and developing groundbreaking technologies, Musk aims to revolutionize these sectors and create entirely new markets. In the early 2000s, Musk founded SpaceX with the ambitious goal of reducing space transportation costs and enabling the colonization of Mars. He invested a significant amount of his personal fortune into the company, with estimates ranging from $100 million to $200 million of his own money. Musk's investment in SpaceX was a gamble on disruptive innovation. The company aimed to challenge the traditional aerospace industry by developing reusable rockets, innovative propulsion systems, and advanced spacecraft. These technologies promised to revolutionize space exploration and make it more accessible and affordable. The risks paid off, and SpaceX achieved remarkable milestones. In 2008, it became the first private company to successfully launch a liquid propellant rocket into Earth orbit. This was followed by a string of successful missions, including cargo and crew missions to the International Space Station for NASA. Musk practices diversification and taking calculated risks. He invests heavily in research and development and embraces disruptive innovation, allowing investors to seek out transformative investments. Additionally, Musk's companies often have synergies and complementary technologies. For instance, Tesla's battery technology can be applied to energy storage and solar products, while SpaceX's rocket technology can be leveraged for satellite internet through Starlink. This diversification and cross-pollination of ideas allow Musk to mitigate risk while still pursuing ambitious, innovative projects. 4. Carl Icahn's activist investing. Carl Icahn, a legendary activist investor and billionaire businessman, has a net worth of over $16 billion. Icahn is known for his aggressive investment style, often involving taking substantial stakes in undervalued companies and pushing for change to boost shareholder value. Icahn's investment strategy involves identifying undervalued or poorly managed companies and then actively seeking to influence their management and strategic direction. He typically buys a significant stake in these companies, often becoming a large shareholder, which gives him the leverage to push for changes that he believes will unlock shareholder value. Icahn's activist approach has involved replacing management teams, breaking up companies to sell off undervalued assets, and initiating shareholder buybacks to boost stock prices. He is not afraid to engage in public battles with company management if he believes it will lead to positive change. In 2007, Icahn identified Motorola as a potential target for activist investing. He believed that the company was undervalued and that its management could make strategic improvements to enhance shareholder value. Icahn and his affiliates began acquiring a significant stake in Motorola, eventually owning approximately 33.5 million shares, which amounted to a 2.4% ownership stake. The total investment in this campaign was roughly $3.4 billion. Icahn's activist strategy involved pushing for leadership changes and operational reforms. He advocated for the separation of Motorola's mobile phone business from its other operations, arguing that it would create more value for shareholders. Icahn also sought a seat on the company's board of directors to have a direct influence on decision-making. The campaign was successful, and Motorola agreed to Icahn's demands. In 2011, Motorola Mobility, the mobile phone business, was spun off as a separate publicly traded company. This move created value for shareholders, and Icahn's stake in the new entity was worth approximately $4.4 billion, resulting in a profit of around $1 billion. Icahn is known for using debt to leverage his investments, often through leveraged buyouts where he borrows money to purchase a controlling stake in a company. He has been associated with corporate rating and greenmail practices, which have drawn criticism, but he argues that they force companies to act in the best interests of shareholders. 5. John Bogle's index fund investing. John Bogle, the founder of the Vanguard Group and creator of the world's first index fund, had a net worth of over $80 million at the time of his death in 2019. Despite the massive assets under management at Vanguard, which were around $5 trillion at that time, Bogle's personal fortune was considered modest compared to the scale of the company he built. Bogle is revered for his pioneering approach to investing. Instead of trying to beat the market by actively picking stocks, Bogle advocated for a passive investment approach that aims to mirror the performance of a broad market index, such as the S&P 500. In the 1970s, Bogle envisioned a fund that would track a broad stock market index, such as the S&P 500, rather than relying on active fund managers to pick stocks. He proposed the idea of an index fund, which would passively mirror the performance of the index, passing on cost savings to investors. In 1976, Bogle launched the first index investment trust, now known as the Vanguard 500 Index Fund. This fund marked the beginning of index investing, offering investors a way to own a diversified portfolio of stocks that mirror the performance of the S&P 500 index. The initial investment required to establish the fund was likely substantial, given the operational costs and marketing efforts involved. The index fund gained traction, and its performance over time proved Bogle's concept to be immensely successful. By eliminating the need for active fund management, the index fund offered lower fees and expenses compared to traditional actively managed funds. This resulted in higher returns for investors over the long term. While the exact figures are not publicly disclosed, the success of the Vanguard 500 Index Fund and subsequent index funds launched by Vanguard is undeniable. As of 2023, the Vanguard 500 Index Fund has billions of dollars in assets under management, and its performance has closely tracked the S&P 500 index. Investing in an index fund gives exposure to a diversified portfolio, eliminates the need for costly active management, and can lead to higher potential returns. Bogle advocated for minimizing investment costs, emphasizing that expenses predict fund returns. Bogle's focus on lowering costs revolutionized the investment industry, leading to the creation of low-cost index funds and exchange-traded funds, ETFs, that track various market indices. Bogle also promoted long-term investing and encouraged investors to adopt a buy-and-hold strategy. He advised investors to avoid trying to time the market, and instead, focus on consistent, regular investments through dollar-cost averaging. Which investment strategy caught your attention the most? Share your thoughts in the comments section below. If you're looking for additional advice on building wealth, be sure to watch our upcoming video. Don't forget to like and subscribe for more valuable content aimed at helping you reach your financial goals.